My name is David Ogundeko, and I am the founder and CEO of Funema. Funema is an impact-focused alternative investment firm where we use venture building as a vehicle to invest in early-stage companies for equity. We've been running for about 9 years now. We operate out of 3 countries, Nigeria, South Africa, and the US. We've got about 20 plus companies in our portfolio. We work with very early stage founders. Our sweet spot is idea stage founders because these are the founders that really need the impact of what we do, which is to help them save a lot of money from hiring the right talent that could help them get the traction that they need to then be able to raise the funding that they need. So it's kind of like a chicken and egg situation for them, for founders at that stage. So we come on board at a critical point in their early stage development, and we help them to build great businesses right from a foundational level. And it's been a very exciting 9 years so far, and I'm looking forward to the next 9 years.
Well, welcome to the African Tech Roundup, David.
Yeah, it's great to be here.
I see you went with the elevator pitch right up front, my guy. Are you in the market shopping for investment partners?
Yes, I am in pitch mode, actually, because I am shopping for investment partners at the moment. So yeah, I guess you caught me there, Andile.
I think our listeners can tell. So before we get to all that, let's talk a little bit about how you arrive at this as a premise. I've been observing the growth and trajectory of Funema for a while now. It is definitely worthy of discussion and actually scaling via this very podcast. And so thank you for doing this. How did you come to this idea? I imagine a number of iterations would have been required to come to a model as specific and as attentive as what you described in your intro.
Yeah, of course, there is an origin story. I think that the most relevant one, because I've gone through a very long journey in a series of, should I say, epiphanies over the past 20 plus years. But I think that the most relevant epiphany was when I was working at Seedstars. This was way back in 2016. I was one of the early team members. I was one of the MDs that they had in Lagos. And my role was to head the academy that sourced for founders and then mentored and then worked with them in the venture studio. I mean, I saw firsthand how, venture building could be very effective in getting ideas from, getting companies from ideas on paper into operating vehicles, generating revenue in a matter of weeks. And I mean, the folks at Seedstars at the time were very brilliant folks that I really enjoyed working with. But I think that the key element that I saw that was actually working was the fact that, these young founders who probably didn't even have any corporate experience, we're working with the likes of Benjamin Benaim and Alice Dutona, and Pierre Lamizan, Alex Weber, the big great guys in Seedstars. And you can already see that the intangibles when it comes to knowledge rubbing off on these founders, and I can see them applying the intangibles to the ventures. And I compare that to the masterclasses that even I organized for like a 2 weeks, mentor madness bootcamp sessions. And I realized that the bootcamps had no effect whatsoever on the growth of the founders, but that day-to-day shoulder rubbing, collaboration with the venture builders was what really helped them to build fantastic business models. So I could see that the venture building model actually works. And I think for me, because I've always been an entrepreneur, I've been trying to do business for as far back as I can remember, even selling hand-drawn comic books back in secondary school. And this is way back in the 90s. So you can see it's been quite a while. But I wouldn't exactly classify that as a business though. But I've had a few ventures in the past that of course failed brilliantly. And then I saw that the venture building model was working, at Seedstars. The only thing that I saw that was lacking was that we were getting founders to work on ideas that we had. And I could see that a lot of the founders didn't exactly have the emotional connection required to be fully dedicated to the ventures. So that was something that was a bit of I would say, an icky point about the model. And then I also noticed that we were quite focused on venture-backable ventures at the time that I was there. And this was back in 2016, and the technology was still very, very nascent in Africa, especially in Nigeria at the time. And I saw there was a need for founders who were building boring businesses that were asset heavy to be supported in the right way. They needed help to grow because they were really solving critical problems that I believe at the time that if they're able to do that very well, they can build infrastructure grade businesses that can really stand the test of time and really become profitable and, of course, scalable in the future. So that was what made me leave in 2017, taking the learnings that I had gotten there, but decided to flip the model on its head and say that, you know what, rather than having our own ideas and then looking for founders to come in to build these ideas, we'll look for founders who are already building their ideas, who have an emotional connection to the problem, who are obsessed about the problem, and then we offer them our own venture building expertise in exchange for equity.
And what do you notice applies uniquely and perhaps to both when you consider the kind of support an entrepreneur who's not building in tech needs in terms of venture building support versus a founder or entrepreneur building specifically within tech, perhaps with the intent of being VC backed and scaling quickly?
Maybe I should try to approach that question from our own investment thesis or how we evaluate ventures. We have a sweet spot, and that is we like working with founders who kind of start out as SMEs. So not necessarily in a venture backable per se, but they've got a solid business model. It's most likely tech-enabled because you've got tech-enabled businesses and you've got pure tech businesses. Because we believe that these founders over time tend to really understand the market. So the great companies tend to start out in multiple stages. First of all, it's an idea and it can be delivered as a service. And then after that, it becomes more of a product because, of course, the founder can start automating a few processes, a few steps in customer acquisition, in value delivery, and then it becomes a digital product. And then, of course, it can then grow from there into being a data company, and then from there it can grow into a platform. So, but you can see that there are learnings and key inflection points that would help the founder build a business and scale it iteratively. It could be done in a very short time span, depending on the market, it determines right, or it could take like a decade or more for them to get there. And we prefer work with founders who are at that service level. Why? Because we believe that that's the hardest place to be in. It's very difficult. You have to be in bed with your customers. You have to really understand them. It takes a while to deliver the product, but that lag in time, that delay, it opens up the opportunity to have wisdom and to really, really understand the customer dynamics and the market dynamics surrounding the customer. And then over time, it's not just about having a great idea. It's not just about being able to raise capital. It's also more about execution, understanding the number of steps and the number of problems to be solved to ensure that those steps are run as efficiently as possible. And understanding that in a very granular way is actually quite important because it means that when it's time to automate those steps, maybe from 20 to about just one step, it can be done very smoothly, very seamlessly, and in a way that can actually scale. So these are the founders that we kind of prefer to work with. But obviously, compared to an AI company starting up from ground zero, how we go about supporting our ventures will not be the same that they would, appreciate. But nonetheless, we focus on three key areas. One is strategy, the second is operations, and the third is financial growth. And we believe that these are core fundamentals that would help any venture establish the right foundation that would enable them to keep on growing and to build very solid and very scalable business models. So these can be applied to just about any venture, but we have our preference, and that's for companies that have unscalable at the very early stages model, because we believe that will give them the opportunity to really understand the market, understand the customer. And then over time, they can turn their expertise, turn their knowledge, turn their proprietary IP. It could be in software, it could be in systems, it could be in knowledge base or whatever the case might be, and turn that into a product and scale across multiple verticals.
I think it's fair to say in the market there's a common sensibility that not every entrepreneur is a tech entrepreneur and not every tech entrepreneur ought to be one. And so how do you think about that as someone who's vetting not just the strength of an idea, but also the merits of the individual looking to turn that into a viable venture?
What is a business? It's basically finding a problem and then solving it in a way that makes the customer happy, provides a lot of value for the customer, and also provides value back to you as a business, which is revenue. And if you can do that successfully at a really good profit, then you've got a business. And it doesn't really matter if it's really fancy technology product or it's just you getting on a call and talking with the customer and then you send an invoice at the end of the day. So what truly matters is that you've got a business model that works. it's really solving a problem, and then the customers are happy with it, and they're willing to pay for you, and they're willing to keep on paying for that product. That to me is what a business should be. Now, you can make it a tech business or you can make it a non-tech business. But in terms of data, looking at the companies in our portfolio, the ones that we're quite proud of is the ones that when they started, it was more of a service-based business model. I can mention a few companies. I've got ProDevs, I've got Pitchprint, I've got OSB. And when they started, they were not exactly your traditional venture-backable business. In fact, they got turned down by a lot of VCs because they couldn't see the scale there. But what they lacked in scale, they more than made up for in depth of expertise and understanding of the market. And now, if I use OSB as an example, it's a pure financial services company. When we started back in 2017, we were offering microloans to open store traders. Mostly women in markets like Aja Market, Tejo Show, and Ijesha Tedo markets in Lekki. And we were very, very analog about it. We would literally go to these women with paper forms, have them fill the forms, would carry the cash in hand and give it to them. And when it was time for them to pay back, we would go there on a weekly basis to collect payments. It was very, very manual. We didn't have any product or any technology interfacing with the customer, but we had a technology at the back end, internal operations, managing our ledger so that we can easily track who we give loans out to. But over time, we slowly introduced technology. For example, the customers kept asking if there was a faster way that they could receive money, because it being manual meant that they had to wait till it was their turn. Even after apply, because of course, we're a small team, we couldn't go to every customer at once. And then we introduced the idea of a debit card where once they apply and the loans were approved, we would credit their debit card and they can go to an ATM to withdraw the card. And then we realized that some of the customers were slowly using the debit card as some kind of a savings account. They were not withdrawing all of the money at once. They would keep some of the money in the debit card so that they could have it later. And then we designed a savings product based on that. And then we introduced the idea to them, would you like to have a savings account and have like a digital wallet where they can actually keep their money? And they loved the concept. And that was how we started offering them a savings product. In fact, we call it the micro savings or savings as a service. And then we built a whole technology to power that.
Wow.
But now that technology that we've built, that's quite impressive, is now being used by big corporates to offer micro payments or micro subscription services to their own customers. So it's becoming almost like an enterprise SaaS solution that can really scale. So you can see that we didn't exactly start out with a very sexy business model, but the learnings that we've been able to get from the market, which we've sort of automated into a platform, is becoming a product that you can call a pure tech business. So it's just one of the ways to engage ventures, because I know that a traditional VC model would not really find it attractive, because that's like 10 years into just developing something that can actually scale. But I know that because of how we understand the market, the kind of relationship that we have with our customers, when we start scaling, the likelihood of high churn will be quite low compared to a growth that is financed by venture dollars from day one. You cannot hack customer satisfaction because people are still people. They make the buying decisions. They would use a product, and eventually, if they don't like it, they'll move on. You just can't hack that. And when you spend a lot of capital just to acquire one customer, it puts you in a very precarious position.
That's shots fired at the VC industry. I see you, man. I see you out here with your AK-47. So a few things occurred to me listening to that. One, keep those anecdotes coming. The other thing I thought as you were talking is you used we a lot. And I wonder, is that because you identify so closely with all the ventures you're backing? Do you take that first person immersive sensibility with everyone you help in this way? Or was this actually a venture you co-founded and later became part of your portfolio?
When we take on ventures, we're quite immersive in the first 2 years, in some cases free, but recently we decided to reduce how long we stay deeply interested in the operations for about 2 years. So it may sound like we're co-founders, but not necessarily, because we need to be immersed in their business model, because that's the only way we can truly understand the company, understand the opportunity, and be able to solve problems as they arise. We sort of realized that compared to quite a number of models out there, building a business is very unpredictable, and events happen in real time. They can be erratic. And founders are kind of like left alone to deal with them in most cases. And being a mentor from afar, when you have like calls once a month, it's completely ineffective in moving the needle on a daily basis. So we realized that we had to be embedded in the ventures that we work with. And for the first 1 or 2 years, we're actively involved in the operations, involved in the strategy. And that gives us remarkable insights into how far the ventures can grow, and what they can become, and we just sort of understand what they do, and it makes us very confident about the companies that we engage with.
I think for a long time, the focus was on the gap in backing entrepreneurs, worthy entrepreneurs, with the finance they needed to grow their businesses. And then it seems in the last 3 or 4 years, we all just suddenly realized that, we were coming out of cycles where there was more money than there were viable opportunities to back. And suddenly it became, money's not enough. We need venture building. How would you characterize the ebbs and flows in interest or in activism around this idea of venture building, and where do you think we are?
I remember, I think about 3 years ago, I was talking to my team members as we back in 2022, because I think 5 to 6 years ago, the idea of venture building was, as you rightly put it, was mocked, was laughed at. People didn't really care about it. And now we can see that there's a need for venture building. And the reason why there's a need for venture building is that we're quite, amazed at what's happening in Silicon Valley. But we forget that the foundation driving Silicon Valley is, multiple industrial revolutions, especially the knowledge industrial revolution that created brilliant academics. So you've got a plethora of great minds that have been well trained from an educational perspective. Plus, you've got people already having entrepreneurial experiences right in college through internships and whatnot. And that's a culture that is really lacking in Africa. We don't really have that. I mean, I can say that, back in Nigeria in the 90s, those who had, parents that were lucky, were probably working in the oil and gas industry, in the banking sector, and or maybe insurance, and that's just about it. It's either your parents are, they run a small mom and pop store, or they sell spare parts, at the market. I don't know. It just pretty much depends. And that's the foundation. That's the culture that a lot of us grew up in. We're quite good at hustling, but we're not really the best in thinking about corporate structure. And yes, we had a lot of VC money coming in the early 2010s, which was great. But then the problem eventually crystallized. And the problem is that, yes, we're quite good at making money. We can turn an idea into a business, but we're not really quite great at building companies because we don't really have the corporate experience. Maybe by working in a corporate, entity, or by growing up around the idea of corporate, we just don't really have that. But I can only speak to West Africa per se. I'm not too sure about the Southern African region, as I can say that South Africa is quite different from the rest of Africa. But that's what has been lacking. And now I was predicting way back in 2022, 2021, that pretty soon a lot of the VC funds will start launching their own venture studios, because now they'll see the need to support their ventures with a bit of expertise around scaling, or at the very least building scalable structures that would ensure that the capital flow coming in can really drive the right levers that can enable scale. So it's a wave, and I think that the venture building wave is here to stay for at least another 5 years. It will eventually peter out towards the 4th year, and then now we have more AI-enabled or AI agents working with founders. But that's as far as I can see into the future.
We've seen Techstars retreat. There's been unfortunate news about 54 Collectives, venture studio biting dust. Antler's moving into Nigeria with their proposition. I'm just naming the ones that are just top of mind for me right now. It strikes me that you are in a field characterized by retreats by Western-backed venture building support players who seem to be either admitting the challenge is far greater than they are able to cater to profitably, or perhaps there are other insights into why this is an area that seems to be, on one hand, widely regarded as important and necessary, but on the other, clearly not delivering the kind of traction that encourages at least Western parties to stick around and keep backing.
We need to have a conversation with our Western partners, and they need to understand that they have had centuries of, industrial revolution, right? And we are kind of like in our own first century in Africa. Maybe we're just halfway through our first century of economic growth. We've only just escaped barely our political landmines in terms of military coups and elections being bought and whatnot. We haven't exactly fully adopted democracy the way it's meant to be adopted. I mean, look at South Africa, for example. We only just recently, in the 90s, ended the apartheid era. And South Africa is meant to be the most advanced economy in Africa. So that already is case in point. We're quite early in our growth when it comes to technological revolution. We still have a long way to go. So why am I saying that? The challenge that I see in venture capital is no problem in advanced economies like the West, like Silicon Valley. But here in Africa, it's a big problem. It's a misalignment of incentives. And yes, even though I may have started throwing lucky shots at VCs earlier, I've sort of learned that VCs are not the problem. It's the LPs that actually back VCs that are the problem. And because a VC can only work with what they have, with what they've been given. I've seen VCs who launch their funds with this grand idea on what they want to do, but then at the end of the day, if the LPs don't want to release capital when there's capital calls, and that's a problem. You have to change your grand idea. Now you have to work for the DPIs and TVPIs and whatnot, and then you're forced to start liquidating your assets by divesting quite early. So I think that the LPs who are interested in working in Africa, or rather investing in Africa, should understand the market and should have a different approach. They should believe that this is long-term play. It's not going to be short-term. 10 years is way too small. Averagely 15, 20, 25 years. Why? Because we need to have a solid infrastructure that can create an even distribution of wealth, averagely, because it's only when you have a market that is quite sophisticated and advanced that you can then have fantastic venture exits locally. And that will create wealth, not just for the fund managers, but also for the economy, for the people involved in technology. And of course, those would then benefit from the technology companies. So 54Co leaving, it's not a failure of 54Co per se. It's more of a failure of the LPs. And also because of the LPs demanding results in a very fast way, in a way that is almost technically impossible, it can then lead VCs to make decisions that may look smart in the short term, but not really smart in the long term, because they have to show results, they have to show traction. And it becomes like a vicious cycle. We need to have a forum, some sort of discussion between LPs and VCs, and then maybe founders who have successfully built companies locally and exited them, like the founders of Paystack, like E, for example, and other founders who have built successful tech companies that were not exactly VC backed. And then let's have a conversation about what can we put in place. And of course, we need to have the government involved as well. What can we put in place locally in Africa that can make sure that everyone is happy? What we have is it's malnutrition, for lack of a better word. VC capital should not be the only capital in play, because it's a marathon race. It's not a sprint. We need different players at key points in the journey of the venture, because they've got different incentives, they've got different expectations. If we're expecting traditional venture capital funds to finance the entire value chain, if you will, that's not going to work. It's just not possible, because timeline expectations are completely misaligned. So we need to have multiple players working together to build this ecosystem. And I think that's the only way that we can have happier funds staying for much longer. But I will say to foreign investors, when it comes to Africa, they need to play the long game. That's the only way they can actually really, really be happy here.
Let me play devil's advocate for a second and say, what would you point to as lead indicators of that assertion on our way to fruition 10 years from now? And how do I, as an investor listening to this conversation, satisfy myself that this isn't just a bullish African naturally and understandably bullish on his continent and the markets he works in. And how can I assure myself that that bullishness is accompanied with a disciplined investment mindset?
If you look at how the African market has been evolving, we've had, what, is it 9 to 10 unicorns now? And we're kind of minting unicorns averagely one per year or one every 2 years. And 10 years ago, that wasn't the case.
Mm-hmm.
So you can see that there's a natural evolution happening and it's growing, and it's only going to grow faster exponentially. In the next 10 years, we will have more unicorns. Why? Because if you look at how Africa is evolving, needless to say, that will be the biggest Black population in one landmass in the next 10 years. So that's something to really think about. We'll have a very young population as well. And that is something to really think about. And you have a population that is also influenced by technology positively, because in the next 10 years, the level of education would dramatically increase. And why am I saying that? Because AI is going to make access to education much more accessible, for lack of a better word. I mean, I'm learning concepts that I know that I wouldn't have been able to learn unless I was paying some hefty fee, trying to get a Harvard degree or going to MIT or whatnot. But I'm actually getting all of that for just a $20 a month OpenAI subscription. And that is it's going to get cheaper over the next 3 years once we have more players and OpenAI is forced to really disrupt their own market price. So the problem that we have around education is not going to be the same in the next 5 years. And what does that mean? It means that we have people who are more upskilled and can go ahead to improve their lives in the knowledge economy. So it means that we have a market that is educated, mostly a market that is enlightened, and a market that is willing to engage in technologies. So apart from just purchasing power, because it's very hard to use purchasing power as a metric. Why? Even though Africans may earn quite poorly, but we don't spend as we earn. We tend to spend more than what we earn. It's always been a cultural thing. You have Africans who probably are living on less than $100 or $500, so $1,000 a month, but you find them wearing designer clothing that is probably 2 times their salary. How did they get it? It's mostly like an internal crowdfunding. They bring 20% and then they're borrowing like 10% from their uncles and aunts. So we like to buy things that make sense, that make our lives better. And we are able to rely on each other to achieve our dreams. So we have a communal nature. So basically it means that, worrying about purchasing power is the wrong metric to focus on. Africans will always buy things. So in the next 10 years, you have this massive population that is much more enlightened because now they have access to education that they couldn't before with the advent of AI, and it's only going to get better in the next 5 years. And then people will tend to spend more than what they make. And of course, there will be growth in their purchasing power. And if they ignore all of that, then it means that they're really going to miss out big time.
So you're making an appeal based on macros, which, okay. That's great. If I pressed you to look into your own portfolio for signs of that case being made, what would you point to?
How do I point to this? That's now you've given me an assignment that I wasn't exactly prepared to do.
I'm happy to let you think about it. And as I skip to another question, we can circle back because I hear people appeal to those macros quite a lot, but that's everyone from heads of state to founders looking to sort of justify a market size as they seek investment. I also hear those macros appealed to, by, interestingly, nonprofits trying to encourage more foreign aid or impact investment to come to the continent. And it's also, incidentally, something even someone like Sam Altman of OpenAI would point to as his sense of, one of the biggest markets companies will be looking to service over the next decade. So you get a really wide spectrum of people who try and frame the business opportunity that is Africa. And I think what tends to be missing, and I think you as a venture builder and someone who basically on risk backs entrepreneurs, and I mean, if your support doesn't deliver actual results, I mean, you don't vest the interest in those companies, right?
Yeah.
You are probably more, in terms of some of the incentives you described or misaligned incentives you kind of pointed out, you are probably better placed than most to have a finger to the pulse of what's real and what's not.
And you're actually quite right, because we are kind of like in the trenches, so we can feel the pulse of the ecosystem.
Yeah.
So yeah, and I think I've got an answer for you now.
Cool.
But maybe have an answer, but I'm just going to share it. So in our portfolio, and also in a broader sense, the companies in the pipeline that we engage with, we are seeing an improvement in the quality of the founders that come to us. And we're also seeing an increase in the number of founders with bright ideas. And it's showing that there's a shift happening in the market. People are beginning to believe that they can actually launch tech companies. They can solve problems that they deal with, problems in the markets that they're active in, and that they can actually build scalable ventures. That belief alone is a strong indication, because it's the first step towards building a company before even receiving support or investment of any kind. And we're quite impressed with the quality of the founders, but also the ecosystem has become it's richer than before. And we have more players providing support. We've got success stories in the market. We've got some exits in the market that is creating a positive ripple effect. Founders exiting previously venture-backed companies that were acquired and starting their own ventures and taking all that knowledge and that culture with them and putting it into the ventures that they're starting. And that's also, in a sense, building employees that could become the next founder. So we're already seeing these indicators at a micro level. And for us, even we have had to take a few steps back, because we've realized that how we've been supporting founders for the past 8 to 9 years cannot work for the next 10 years, because the level of innovation that is happening is moving at such a pace that we will be left behind. So we need to rework our value proposition because the level of risk that we're facing now is not the same level of risk that we faced a couple of years ago, when we started in 2017. It's not the same level of risk. It's a bit more sophisticated. It's not existential risk that, oh my God, if you don't help me, I'll die kind of risk. No, it's not. It's much more complex than that. And it shows that the market is slowly maturing in a sense. And now we've also got this interplay of, Africans in the diaspora who are well educated. They've got some means intellectually and financially, and are also coming back to support founders locally. And that is only going to get more and more active over the next 5 years or even more. And you see that knowledge sharing in terms of global standards and local expertise combined together can be very interesting to watch. So these are indicators that I'm already seeing as a venture builder. And then I'm also seeing the quality of the talents as well. So we have an academy where we train young college graduates into becoming venture builders. And then we've trained a few that are doing quite well, in the ventures that they've been working, that they're currently working at. And these are young people that in your early 20s. And I keep telling them, look, you guys are rock stars, because when I was in my 20s, all I cared about was playing video games, and wasn't just the latest Resident Evil game that I could play. I only got serious towards my mid-20s, but in their 20s, they're already working in venture, and that's just remarkable. So the level of education, it may not be as evenly distributed as it was in the past. And even still now, we cannot exactly say that we've got the same level, the same standards that you find in the US, for example. But because we've got a lot of knowledge put online, a lot of expertise put online, the internet has disrupted that, and people are leveraging that access to develop themselves and apply what they're learning, to the venture. So there's an explosion of knowledge. And pretty soon there'll be an explosion of intelligence using AI. And I think that would really change the dynamics, because there's a lot of power in the hands of young individuals. They will only be limited by their imagination. I think that the funds that are pulling up now, they're choosing the worst time to pull out of Africa.
Well, let's talk about then your fundraising efforts then. How has the current climate impacted where you look for investment partners, how you vet them for applicability or suitability, given not all of them might share your view of how long things might take to come to fruition, and or appreciate the nuances of what is, in your case, a fairly category bucking hybrid sensibility?
I have been in a funding winter since 2017, so I'm not new to this class.
Are you one with the winter now?
Yeah. I mean, winter has come, or winter is coming. It's been like that for me.
You are
winter. I am winter. Basically, I am winter, because when we started and we were trying to raise a fund, it was quite difficult to sell that because the investors didn't really understand what we were trying to do.
So what the idea was, what, a sidecar fund to sort of back the potential you were interested in, or how was that going to work? And how has you evolved your thinking about what you need money for now?
So what we had back then, we said that we've got a pool of companies. I think there were about 10, 11 at the time. And then we're trying to raise $1 million. And we said that we want to deploy this entire million into all the portfolio, both the ones that were still at the idea stage and the ones that were a bit more mature. And then investors didn't understand that. They felt like, why can't we just focus on the ones that were already growing and showed a bit of traction than to deploy the capital into all of the ventures all at once? And then we said that we have an ecosystem player. We cherry-picked these companies because we saw that they were playing across different segments of the market. And we know that these segments need to work together to ensure that their products can have traction in the market, because the market is fragmented, not just from a distribution perspective, but from a tech adoption perspective. It's very hard selling a product that is heavily reliant on quality internet access or a high-tech smartphone, but then the target customer doesn't have enough data to even use the solution and probably uses a very poor low-tech phone. It may be a nice smartphone, but it could be something that it's not exactly your iPhone, it's not exactly your Samsung and whatnot. So their experience of the UX is heavily limited, and that could lead to dissatisfaction. It could lead to the product not being sticky. So when we select the companies, we're selecting companies that were offering solutions in connectivity. We had a company at the time that was providing mesh internet connectivity in rural areas. We had a fintech, Duca, that was providing a payment solution for companies, but integrated, where we had a digital bookkeeping software installed that also gave the merchants business intelligence, but also a hardware that enables them to use the same device to collect payments digitally. So we believe that all our companies had to work together because we also had OSBs who were providing financial services. So we know that if they would need to collect the POS, they will need to have a bank account that they can trust to provide them the best services that they cannot get from established commercial banks or retail banks. And they also need to have steady power supply and internet access to use this product successfully. So we had an ecosystem play, and we wanted to maintain that ecosystem play. But the investors that we're speaking to at the time, they really understand that because it wasn't a traditional venture fund. So that was a failure. I think this was way back in 2019. We tried to raise this, this fall. It didn't work. I went back into winter. Obviously, it wasn't time for summer. And what we've done now is to kind of like unbundle the capital model. So we've got a sister company that we call Good Harvest Capital. And Good Harvest is structured to be a pure venture fund designed to cherry pick the best companies in our portfolio to invest in that have the traction. So we know that when we pitch that to traditional LPs, it's pure vanilla play. It's 220 and it's simple. They understand it. Yeah, take my money, go invest it. But for the venture building operation, what Funema is focused on, we've realized that we need to be quite smart about it. And now we're looking at partner with grant organizations that are much more patient, and then maybe debt organizations or debt funds are looking at maybe zero interest rates or single digits over, 10, 25, 30 years, because that's enough patient capital and the ways that we can leverage to invest in companies, and they can take their time to build their products well, because founders need time to build business models that actually work. It's much more important than having distribution. It's much more important than having the right tech features or the right product or engineering team. If the business model doesn't work from a dollar and cent or naira and kobo or random cent perspective, then it's already a failed enterprise. You're just pouring money into something that would eventually fail. It's just sort of amplifying the rate of failure or the scale of failure at the end of the day. We strongly believe that founders need time to truly understand the market. So they need the kind of capital that comes with, support and expertise that would enable them to understand the market. And once they get that, once they find that true niche that can give them steady flow of income, now they know they can start experimenting with technology. They can start building, a nice UI, UX and whatnot. They can start leveraging AI. And AI at the end of the day, it makes no sense if you don't have your own proprietary data to fine tune it. And that data can only be gotten by interacting with the customer or the market over a period of time. So, and it needs good data. So it can leverage, it can have some sort of, decision hygiene. And it's not just automating biases or whatever the case might be. So what we're looking at now is leveraging grants and a bit of debt to help the companies in our venture portfolio. And then once they are gaining traction, then our VC fund can come in to then cherry pick the best companies to then invest in. So it's like I did say earlier on, it's kind of like a marathon play. Where I learned that trying to raise a VC fund for pre-seed funding to make pre-seed investments, it makes no sense. Because at that stage, the level of uncertainty is very high, and you cannot exactly predict how long it will take for a founder to develop. And you've got like 5 years to start seeing traction, so that you can start planning to exit in the next 3 years within a 10-year fund life. And that's just not going to work. The best time to invest as a venture fund, sadly, and I'm actually going to say this, is at the pre-series A level. Because seed is still quite risky, but it's not as risky as pre-seed. But founders need money anyway to scale what they're building. So they have to take capital. So it's just, we need more models. And we need investors who believe in those models. But for them to believe in those models, they have to believe in the continent, and they have to believe in the opportunities there to dance that kind of dance, to learn a new dance style and participate in the ballroom to dance it. And that's what I think will be the way forward.
I'm becoming particularly sensitive to the extent to which someone listening to this podcast could be using it to frame their career prospects, or how stuff we're talking about on a pod like this could be informing their aspirations as a young person, weighing the options of all the different things they could do with their lives and how they could make a livelihood. What stands out to me is the number of times you've said AI on this on this podcast in light of that thought, one. But then the other thing that stands out is, I suppose, lazy assumptions about who and when and how people should become entrepreneurs, on a continent where many young people, many people, period, are entrepreneurs not by choice, but because, reality demands it. And yet the kind of entrepreneurship I know we talk about a lot on the show, and correct me if I'm wrong, is one that actually does require a certain dedicated professional approach to elevating raw talent that might be at play. These are a number of different things, and ideas and strings that, coming to the end of our conversation are kind of loosely hanging in my own mind. And I'm listening to you. I heard AI. I heard you mention talent and the right kind of founders and what you're looking for. And I wonder how you would frame the opportunity to be the kind of founder you would back to someone listening right now, and how someone would know they're that kind of person, and whether that's something that's a result of sheer talent combined with some kind of exposure to best practice, maybe in a business or in a startup or in corporate, or are any of those unfair?
No, they're not.
Distinctions to make or exclusive propositions to pitch in light of, how everyone wants to be a businessman these days, or businesswoman.
So yes, I did mention AI quite a number of times, if not throughout the entire conversation. But I think that is quite remarkable. I mean, what you have is the knowledge of the entire world at your fingerprints in the way that you can interact with. That's what you find in AI. You've got the knowledge from bright minds embedded in this digital entity that you can interact with, and then this entity can start mimicking how you think, and then it becomes almost a mirroring effect where you feel like you're talking to a human being. So you'll have this sidekick that is just like Merlin. It's like the Merlin to your King Arthur, so to speak, right? To use that as a reference. It's very empowering.
Your personal wizard.
Basically. And it can be quite empowering, for good or for bad, depending on who's using that power. And I think that's what makes AI quite a delicate topic and a delicate feud to manage, because humans still have agency to do what they want to do. But I think that what it does for people in frontier markets who have been kind of marginalized from accessing certain kind of knowledge academically is that now there's a platform that they can leverage. And this platform is always on unlimited access to knowledge and information that they can leverage in a way that they can use it to build or design a career that they want. That's really powerful. And I think that as more people in Africa, although obviously there's a need for us to make AI inclusive for people in emerging markets. That is something that this organization called AI for Developing Economies, which I'm a member of, is currently trying to ensure. But beyond that, I think that it's going to really change the dynamics in terms of potential being utilized, optimally. Now, in terms of the founders that we look for, the way we build ventures, what we really focus on in Funema is how to help founders to either reduce the number of errors they make in their decisions or to leverage the errors to improve their decision-making process. And that's what we really focus on. When we say we do strategy, we don't mean, we're going to help them with their business model canvas. No, that's not what we mean, because anyone can do that these days. We have our own proprietary frameworks. What we focus on rather is the right mental model, because there's a lot of content out there, but content is actually quite relative. It depends on what level you are in the stage of your business. Because if you apply the wrong content, if you apply the right content with the wrong context, then that's already a risk for a disaster. We see a lot of founders falling into that trap. So we help them with having the right thinking heart, the right mental model, almost like a filter to identify the right content that they need at the right time and apply it to generate the right outcomes or the right results optimally, of course. And that's what we really focus on. And what we need is founders who just have the passion, who have spent time interacting with the market, interacting with the problem. Founders who almost feel like they've been called to do this and they can't see themselves doing anything else, because we take a high level of risk. We don't rely on the power law approach. It's really about absorbing risk as much as possible. So unless we're sure that we can work with a founder over a longer period of time, then we know that we cannot, step in.
So this isn't great for the dabbler. Funema is not where you go find yourself to go see if maybe this thing works for you.
No, you should know yourself before you come. But we're thinking a bit differently now, because I did mention that we're thinking of a few pivots here and there. And we've realized that, because yes, we've got 20 plus companies, but it took us about 8 years to get there. And if we keep on at that pace of compounding, maybe in the next 8 years, we probably have about 100 plus companies. But that's not what we want to accomplish. We want to be able to impact close to 1 million companies across the globe, across the continent, so that we're thinking differently on how we can engage with having multiple layers. So now we're thinking, we've got a project we're currently working on, where we plan to reach out to 1,000 founders over the next 2 years. We're finding ways to make our value proposition deployed in 2 stages. And the first stage is going to be high quality, but low resolution, in a way that we can interact with a lot of founders at the same time. And then, of course, we then select the companies that make sense, that can really align with our thesis and ethos into our core venture building portfolio that we can then work with long term. So that way, it's like a double impact, where on one end, we are developing the ecosystem, but then we also have our own portfolio of great companies that we're backing, because we know that the ecosystem needs to be developed. Because at the end of the day, companies do not grow in isolation. They need a healthy ecosystem that is providing good solutions, that is educating the market, so that when they interact with the market, there can be a high possibility of tech adoption. Because when the market is not educated, then you have to educate the market all over again on how to use your product. And how, you need to first of all buy this phone, and then you have to download the application, or you need to go to this browser, yada yada. I mean, all of those hurdles that makes customer acquisition heavily fragmented would have been solved already if the market is developed at large. And that is something that we're quite passionate about. And on the other end, in terms of the academy that we have, where we train founders. So we train venture builders into, we train young college graduates into becoming venture builders. We also want to scale that so we can have a lot of venture builders out there. We're looking at maybe clocking about 100,000 over the next 5 years, God willing. And because we've also seen that founders have tunnel vision. They can be very focused on the problem, and that could expose them to a lot of blind spots. Maybe, third-time founders who have successfully built companies and exited, yes, they kind of have like it's what I like to call spatial experience, in a sense, to be able to coordinate multiple things at once without losing sight or losing focus on the blind spots. But for first-time founders or second-time founders, it can be quite tricky. So they need someone who's with them, who's on their team, but is not incentivized by a paycheck. And also is an investor, but is not incentivized by returns on investments. So this is someone that they know that, when the going gets tough, right? This is tough, going with them as well. It's not okay, what have you done kind of relationship. It's it's a, oh, what can we do kind of relationship. And they need that. And it's going to be quite helpful because these builders will also be plugged into our own resource network and, of course, knowledge and expertise base. So when the founder has one builder, it's not just one venture builder. He has access to over 100,000 to support them in their journey.
Ooh, sounds like a full plate there, David. Really exciting to hear what you have on the go. And needless to say, we will be watching very, very closely. I, of course, have a special interest in this area, given my history in venture building by way of being part of the team at 54 Collective for nearly 3 years. And also just having happened upon your model and the work you do, super impressed that you've done it for as many years as you have without the kind of cushy backing certain other players in the industry tend to have in order to make ideas like this come. And also just how you've innovated from all the data and learnings that you've amassed doing this work, and then just to see your portfolio grow. Yeah, hats off to you. A big thank you for jumping on the pod. David Ogundeko of Funema, thanks for being on the African Tech Roundup.
Yeah, this has been fun. Thanks for having me.
Absolutely.